Welcome back to Modern Multifamily. I'm your host, Mike Wilbur, and before we jump into today's episode, I have two favors to ask of you. First, if you have found any value in listening to Modern Multifamily, I would really appreciate a review, whether it's on Spotify, where you can hit the star button, or on Apple, where you can do the same and actually leave a text review. I would appreciate it. It would help the show grow. And if you've got any feedback for me, I'm always asking for it. Please drop me an email, mike@modernmultifamily.fm. I would love to hear from you. Secondly, I've launched a newsletter. I'm deeply passionate about prop tech, multifamily, industry, leadership, and just raising the bar through conversation. So once a week, I'm writing a newsletter that's going to be 5 minutes or less. And this week, I shipped my 10th issue. If you head over to modernmultifamily.fm/newsletter, you can sign up. And if you don't like it, I promise it's really easy to unsubscribe. All right. I was fortunate to spend some time with the CEO and founder of CommLoan. His name's Mitch Ginsberg, and I'll be honest, I do not know a ton about commercial real estate lending. What I've learned in talking to Mitch is that there's a lot to be done here to make it easy for borrowers to connect with lenders. And in Mitch's words, they are radically redefining this category. It was fun to learn from Mitch on how the business works, what makes them different, and why he's still so excited about the business being over 8 years into it. This conversation with Mitch was fun, and it was also fast-paced, and for me, I learned a ton. Now let's get into this great conversation with Mitch Ginsberg. Mitch, welcome to Modern Multifamily.
Yeah, hi, Mike. Thanks for having me.
I would love to start with a little bit of your background, who you are, and how you found yourself at the helm of the business you've built and created.
Great. Well, as you can hear from my accent, I was born and raised in the deep South, the very deep South, South Africa. Was born there, educated there, have a bachelor's in accounting, a master's in finance. Practiced with one of the big eight at the time, international consulting firms, Arthur Young and Company. Moved to the United States, got certified as a CPA. Probably after about a year, figured out that wasn't quite my personality. Got into residential mortgage banking, built a pretty large residential mortgage bank over 25 years. And then '08 came along, which was a very interesting time. We were in several Western states, including California, Nevada, and Arizona. So we were probably in 3 of the 4 worst hit states. Property values plummeted, in some cases as much as 60%. So there were a lot of strategic foreclosures where people just walked away from their properties. We had funded, huge volumes of loans in the 5 years leading up to the collapse. So needless to say, we were bombarded with an avalanche of buyback requests from the agencies, and got to the point over probably a 3-year period that I tried to fight it, that it became overwhelming. I wound down the company. Fortunately, no bankruptcies or anything, just lost a bunch of money because I was sort of funding the company while trying to fight the tsunami. And then really got exposed to commercial real estate. Started doing a few deals, and I said, how does anybody know where to go? Because unlike residential, commercial real estate lending is a lot more complicated. Residential is very homogeneous. You've got really 1 to 4 unit properties, maybe the odd condo or townhome. You have your products are essentially the bulk of it's Fannie Freddie. You have a few FHA, VA, and maybe a few portfolio products. Your actual loan types are 30-year fixed, 15-year fixed, which dominate, and a few intermediate arms. So it's very simplified, very homogeneous. A lot of technology, even from 25, 30 years ago, with Fannie Mae and Freddie Mac with the desktop underwriting and loan prospector. Commercial real estate lending is the antithesis of that. For starters, you've got all these different types of lenders. You've got banks. Not all banks are created equal. You have federally chartered banks, state chartered banks, community banks, credit unions. You then have life companies. You have CMBS. You have Fannie Freddie on the agency side. You have Fannie Freddie, which is agency on the multifamily side. You have HUD loans on the multifamily side. You have private money lenders. So you've got this multitude of different types of lenders. And then to further complicate the the scenario for the borrower, you got all these different property types. You got, your what we call the four main food groups, right? Retail, office, industrial, and multifamily. But then you've got single purpose properties like gas stations and car washes and self storage, and then you have hotels, and then each one of them have subcategories. So, for example, hotels, you have full service, limited service, flagged, unflagged, open corridor, etc. So, and each lender has a particular property type that they like to lend on. And then you got all these different programs ranging from, literally monthly adjustables, your intermediate adjustables, which would be, say, your 3-year, 5-year, 7-year, 10-year are the most popular. But then on HUD, for example, you can get a 30-year fix. So once again, needless to say, the borrower really wasn't and isn't well served in this environment. So I was thinking, how does anybody know where to go? How, it's so complicated. Will this particular lender do exactly what I need? So I went online and started searching, and there really wasn't any kind of search engine. So the natural assumption after that is, well, if it's never been done, possibly it just can't be done. Well, that's not something you would normally tell me. So I went ahead and started interviewing a bunch of different lenders. I went to CMBS lenders, Cantor Fitzgerald, Goldman Sachs in New York, interviewed a bunch of community banks, credit unions, and found out that there were about 30 key variables that are common for a lender to size up any loan, irrespective of the type of the lender. And some of these variables are, every lender has a particular lending footprint, right? They'll lend either in a particular city, county, state, metropolitan area, but you can define this is where they'll lend. So that's a search variable, right? They'll then lend on a minimum or maximum loan size. That would be a second search variable. They'll lend on a particular property type, third search variable. And you go on to the various algorithms like debt coverage ratio and global debt coverage ratio, or debt yield, which are simply mathematical calculations. Time to close. Every lender has a specific timeline that they need to close a loan. Is it prepayment penalty? What's the term on the prepay? Is it recourse or non-recourse? And then if it's recourse, you get into a whole bunch of variables relating to the sponsor, their citizenship, their credit score, their income, their debt, their liquidity, their net worth. Have they declared bankruptcy? Have they had property foreclosed? So we're able to define these variables. We capture the variables from the lender, and then we capture those very same variables from the borrower and are able to match the two. And that really was the basis for developing a database and a search engine. I'm not a tech guy. I was very, very fortunate to hook up with who is now our CTO, a really smart guy out of Northern California. Already had a phenomenal team built in India, which we took over a big portion of that team. And I guess him and I met. We did the proverbial lock yourselves up in the conference room for about 3 days on a whiteboard, drawing what I thought we needed, and he said, all right, we can build it. So went out, raised a little bit of friends and family money, and I guess 7 years later, here we are.
What a story. Hearing you talk about that has me feeling confused, and it feels like technology is the obvious solution to that. Looking at your LinkedIn page and now hearing you explain it from the founder's perspective, it sounds like you're almost like a Tinder or a matchmaker for lending. Like, is that how you think of your business, as being a matchmaker, or how do you think of it from like a simplistic standpoint?
Almost the analogy that I draw in the olden days, when people would travel, they would go to a travel agent, right? And that travel agent had limited access to a certain number of airlines and a certain number of hotels, and they would book you. Was that the best for you? Probably not, but that's who they booked you with. And fast forward today, and you have all these online platforms, Travelocity, Priceline, Orbitz, etc., and you can pretty much choose any airline in the world and any hotel in the world, and that's who you'd go with. And to a large extent, travel agents have disappeared, with the exception of your real specialty travel agents, if you're planning a donkey trip through the Himalayas or something. So we almost look at ourselves as that online platform, whereas the typical mortgage broker is the travel agent. So like most other online marketplaces, we really are giving that borrower better access. And it's quite funny. I'm sure you're familiar with the golden rule, right? He who has the gold makes the rules. And up till now, the lenders have had the gold and they've made the rules. And we've actually got a poster of the golden rule framed upside down in our offices. And the reason is we want to really turn that on its head and empower the consumer, empower the borrower, because the borrower has very specific needs. There's so many different variables that a borrower might find important when getting a loan. It might be, prepayment or lack of prepayment is very important to me. That's my number one criteria. Or it might be interest rate, or it might be payment. Payment and interest rate very often go a little bit together, but payment could be influenced by amortization or by just interest only. It may be maximum proceeds. So we're able to really define for the borrower what is important to you. What is the key variables, and we can rank them. Number one is maximum proceeds. All right, you want the highest loan to value. Number two would be, I want the lowest payment. Okay, then payment. And we go down the list, and then we use those variables to match the borrower with the perfect lender that fit for that location, that type of property, that loan side, fitting the various algorithms like debt coverage, global debt coverage, if it's recourse, fitting the sponsors criteria. So we know that when a lender gets that package from us, they want to see that deal. And so that's very, very exciting. It creates an environment where it's not just, almost like the borrower having to going to Vegas and rolling the dice and hoping they're going to get a good deal. Here, with a very high degree of certainty, we are taking that loan to, in many cases, between 6 to 8 of the top lenders that best fit that borrower's needs, and opposed to the lender saying, well, let me see if I can fit you into my program guidelines. The borrower's the one who's ultimately going to be choosing the lender.
It feels like you've really, really identified who your customer is. And before we hit the record button, you talked about the famous Bezos quote from the 90s. How
Yes, yes.
how has your approach iterated and evolved over the past? I mean, I think you're coming up on 10 years in business. I have to assume this is morphed as you've heard from your customers, looked at the market, things have picked up, ebbed and flowed. What's the evolution been like for the business?
Yeah, I think our guiding light has always been borrower experience, because I think that's the guiding light to any successful business. You got to build what the borrower wants, not what you think they want. So I think that's been the key. I think part of the evolution really just has been our path as far as customer acquisition. Initially, we started off, we thought, the low hanging fruit would be, there's all these thousands of mortgage brokers out there. Let's give them access to our technology, and if they do a loan through us, we'll do a revenue share. I guess human nature is, if they figured they could place the loan themselves, even with an inferior product for the borrower wouldn't be any the wiser. They would do that. So we found that the quality of transactions that were being fed to us by the mortgage brokers really were less than desirable. Let's put it that way. And so we pivoted and really went to consumer direct, getting to the borrower directly, and building strategic relationships with various entities that had relationships or access to borrowers. And that has proven to be, extremely successful. The quality of our loans have improved dramatically. And once again, really, really focused. So after every loan closes, we send an interview. We send a questionnaire to the borrower. In certain deals, I'll actually call myself and ask, how did we do? What could we have done differently? Our net promoter score is really up there with the best of them. I think what's sort of pivoted is our business plan as far as customer acquisition. We obviously, as we learn a process, we'll replace it with automation. So we'll first do it manually, understand it, perfect it, and then we'll build the technology around it. So the object ultimately, and we're pretty close to this, which is very cool, is, so up till now, we've really been doing loans $1 million up, and we're going to open up the below $1 million pipeline. And that's going to be a fully automated process, because nobody wants to do those loans because it's very difficult to make them economically viable if you have a lot of human capital involved. So we've built a fully automated journey, but this is after several years of experience of what process flows and what their journey needs to look like in order still to give a phenomenal experience to the borrower. And so ultimately what's going to happen with this journey is the borrower will go through and based on how they'll answer particular questions, they'll start going down different paths. But at the end of the day, they really, without really knowing it, they're actually going to be building their own package. And then that package will, and they're going to have the same access. But instead of having that consultative approach, which we have on the larger loans, where we have a loan consultant up front who works with the borrower, who counsels with the borrower, we have a transaction manager in the loop who processes the files and interacts with the lenders. Our technology will really bridge that gap on the very small loans, and the borrower will really then interact just directly with the lenders, but essentially get that the same experience. So we would be replacing, those two individuals that are currently involved in the larger transactions to ensure the borrower gets this phenomenal experience. We'll be replacing those two individuals with technology, which is really exciting. We'll perfect the model on the smaller loans and then just see where the resistance point would be on the larger transactions, because I think we're dealing with a very high dollar technical product. So I find it very difficult to believe, and maybe I'm wrong, maybe I'll be pleasantly surprised, but I find it pretty difficult to believe that on a 10, 15, $20 million loan, it would be a fully automated process. I think you still would need that concierge service of having a very seasoned originator in the loop to counsel with the borrower, and then a transaction manager, running the spreads, or an analyst running the spreads, and interacting with the lenders and really providing that additional service. But who knows? Maybe one day it will be totally automated with all the AI coming down the pike. I think anything's possible at this point.
Oh, I do too. Well, I mean, I Googled a couple of things while you were talking about, focusing on the borrower and the customer experience. And your review profile is like world class. I mean, I'm looking at your Google reviews, your Better Business Bureau profile is accredited A+, which you like never see. You definitely must be doing something right.
Well,
I have a question.
So that's it.
Go ahead.
I mean, once again, our guiding light and our North Star has always been customer service, customer experience. So, I think, once again, taking, and you mentioned Bezos's quote from the 90s, the technology is great, the internet's great, but it all comes down to customer experience, and in our case, borrower experience. So I guess that's our scorecard, I guess, of are we in fact managing, the borrower's expectations.
So, one of the questions I have for you, Mitch, not knowing a lot about the space, we're definitely in the same industry, but on way different spectrums. To me, it sounds like you're either creating a category or just radically redefining a category. And I'd love to hear from you. How do you see it? The way that CommLoan has gone to market, gone customer and technology first. Is this a new category or just redefining the rules for how the category works?
Yeah, I think we're really redefining a category or a space. We're a tech company that lives in the mortgage broker space. Um, as I said, 2/3 of all commercial real estate loans funded within, the million to 20 million range are originated by third parties. So the lenders are used to getting loans, but they're getting the loans from a multitude of different, quality or level of, the level of profession, a lot of different brokers who are going to vary in their level of professionalism and the quality of the packaging. So what we're really doing is not only looking to provide a better value and a better service to the borrower, but also to the lender. The exciting part about what we're doing is there's a high level of predictability on our packaging from the lenders. It's very standardized, extremely complete. So it makes it a lot easier for a lender to get one of our deals and literally just put it in front of their committee to get an initial term sheet for that particular borrower. So the and also using technology to avoid emailing documents back and forth. And so what happens is our initial what we call a pre-qual certificate, which is our initial quotes that best fit that borrower's needs, are populated into a portal that the borrower would get access to. And then from that point on, the borrower conducts their entire transaction through that portal. They download their forms, upload documents. They get all their lender quotes through that portal. They select the lender they want through that portal. They continue to track the status of the loan through the portal. But then the lender has a portal as well. And the lender can update their lending profile through that portal. They can quote the loan through that portal. They download our package and all the borrower documents through that portal. So we've really created this self-contained ecosystem that really is a huge benefit to not only the borrower, but to the lender as well. And, creating efficiencies from a security point of view. We have, the highest level of, nightly or daily scans for hacking and that kind of stuff. So it's definitely a lot more secure than emailing sensitive documents back and forth. Everything stays within the self-contained ecosystem.
Well, I really like that you kind of talk about yourself as being a technology company that happens to be in the mortgage lending space. I'm seeing that is like the biggest reframe right now in business, especially in multifamily, Mitch. A lot of the customers or future customers I talk to right now are rethinking about how their business should, think and operate rather than just being a multifamily operator. No, we are a technology and human capital business that happens to operate apartments. And I think that way of thinking changes. It just changes how fast you can go and also how great you can become. I think it really raises the ceiling.
Absolutely, because at the end of the day, what technology does is just enables us to have access to so much more data than we would have normally had access to. It enables us to organize that data so much more efficiently than we normally would have been able to do. So really, I don't believe that there should be any one industry that shouldn't embrace it to create better efficiencies and ultimately a better experience for their customer. And that's really what it's done.
Well, as you look forward, the rest of 2023, you're probably already thinking about what 2024 needs to look like for your business. Is there anything that you're embarking on? I mean, you've talked about maybe going down market as an opportunity with smaller loans. Are there any other aspects of the business that you're excited about, or anything you maybe want to share with the audience?
Yeah, well, we're creating a lot of cool little tools that we think could be of value for either the borrower or anybody in our industry, in related businesses that essentially are all in either the multifamily or the commercial lending industry. We're really excited. We've got a rate sheet that now can be embedded into any website. And this rate sheet is live. I mean, it's live rates that are updated daily, and it's an average of these 700 lenders in the different categories. So really, for the first time, anybody could get a very accurate snapshot of where banks are on commercial, and it could be 5 years. I think we look at the 5 years, 7 year, 10 year. So where banks are on commercial, where banks are on multifamily, where agency is on multifamily, where agency is on CMBS. Not agency, where multifamily is on CMBS, and where commercial would be on CMBS as well. So it's that's a really cool tool. We've created it's almost a little calculator that borrowers can go ahead and play themselves and just look at different loan options that they would qualify for. So I think we want to try and create as many value add tools as possible to create better access and a better experience for the borrowers, which is really exciting. We also, it's almost counterintuitive. One would think in this environment of rising interest rates and credit boxes tightening up, that we would really be slowing down, and we're not. And I guess the reason is a lot of, when things are good and very stable, and a borrower pretty much knows that they can go back to their bank and re-up at the same 3%, at 75% loan to value, and they've done this for the last few years in a row. It's very difficult to get them to look elsewhere because it's just easy, it's convenient, and things have been very stable. I think in this environment with rising interest rates and credit boxes changing, borrowers are starting to shop, and they're shopping online, and they're finding us. And so for us, we almost see this somewhat turbulent environment as a breakout moment for us. And I think any breakout technology happens at these times when things aren't as stable as they've always been. And we've gone through the last 10, 12 years of very, very stable interest rates and stable guidelines, and for the first time, things are really moving and changing at a rapid rate, and we're excited about it. We just see this as an enormous opportunity for us.
We're definitely at an inflection point, and I think that when headwinds come, it typically is when the best growth and change comes. And I see, but also share that same perspective, Mitch. I'm really happy to have been able to hear the story from you today.
Yeah, great. Well, certainly appreciate you having me on board.
I want to wrap with, a gentle curveball. I'm in 20-degree snowy weather here in Arizona. I wish I was in your chair today doing this live and in person. Do you have any questions for me before we wrap up today?
No, just really excited about what you guys are doing with Rent Dynamics. Sounds like you're really on a path to redefine, I guess, the renter's experience, right? And create a better environment for them. I think one of the key initiatives, which I think is really cool, that for the first time, renters are able to impact their credit score, which up till now has been, a huge void. I mean, they make their payments. Why shouldn't they get benefit of that? And, so I think kudos to you guys. I mean, once again, it looks like you're very, very focused on creating a better experience and better options for the renter.
Thank you. We're definitely excited about it. And Mitch, before we wrap up, I'd love to roll out the red carpet for you. Anything you'd like to share, whether it's how to get in touch with you, the business, or maybe even any important roles that you're trying to hire for over at CommLoan before we wrap up.
Well, we're always looking for good people, looking for good originators. We're actually starting a pilot program where we're hiring remote originators with experience. So certainly would be happy for any seasoned originators who want to be part of a fast-growing, dynamic tech company that lives in the commercial real estate lending space to reach out to us. Our website is commloan.com, COMM, 2 M's, loan.com. My email is mginsberg, MGINSBERG @commloan.com. Feel free to reach out to me, anybody with any questions, concerns, and certainly if I'm not able to help you, I'll hook you up with the right team member in our organization who can help you.
That's the way. Hey, well, thank you again for joining, Mitch, and I look forward to chatting with you soon.
Sounds good. Thanks for the time, Mike. Thank you.